All right, hi everyone. Welcome to today's webinar where we'll be covering fundamental trading strategy. This will be the second and final webinar for this series. Okay, just want to make sure that you guys can see me and hear me clearly as well. Right. There's also the question chat, so please send in your questions here, and also do let me know if you can um, hear me clearly as well and see the screen and the slides too. Okay, let's just wait a couple of minutes before we start the webinar. You see people coming in. All right. Try this. All right. Okay. Just want to know, can you guys hear me loud and clear? Yes. All right. Perfect. Thank you. All right. Okay, I think believes Jose, maybe Spanish C. Yes, C, res. All right, thanks guys. Thank you. Okay, so this is part 2. So okay, let's just kick things off. We've got quite a few people already tuned in. So let's just start today's webinar. All right. Okay, so this webinar is brought to you by IC Markets and will be covering the second part of fundamental trading strategy. So just a quick disclaimer before we kick things off. Okay, so the information and material provided in this presented in this webinar is purely for educational purposes and does not constitute any investment advice. And also do take note that trading CFDs come with a risk warning. They are complex instruments and also come with a high risk of losing money rapidly due to leverage. Okay. All right. So today, I'm your host for today. My name is Ketan Ramachandra. So I'm an investment analyst with Everest Fortune Group. So this webinar is brought to you in partnership together with IC Markets and Everest Fortune Group, where we have been the best finalists for FX and equity research from 2019 to 2021. Okay, so here's the agenda for today. We'll just start with a quick recap of what was covered in the first webinar, and then we'll look at the central banks with regards to the ECB, SNB, the Swiss National Bank, European Central Bank, and the Bank of Japan, because there were some questions from the first webinar regarding the currency pairs for Euro Yen and Euro, or is it, and Swiss Yen, right? Yep. So there were a couple of questions, so we'll look through these two currency pairs and also what the central banks have been doing, or the respective central banks have been doing. And then we'll look at the recent economic data that has come out, which is basically the employment report, which was released last Friday, right, in the US, where we had strong NFP numbers and low unemployment rates. And one of the big events coming up this week would be US inflation data, which will be released on tomorrow, right? Tomorrow, 10th of May. We'll look through the calendar again, but I believe, if I'm not mistaken, it's 12:30 p.m. GMT. That's when inflation data will be released tomorrow, 12:30 p.m. GMT. And then finally, we'll look at gold and real rates or real yields. What is the relationship between gold and real yields? So we'll start off with the recap. Okay, so once again, Forex Factory will be one of your primary sources for getting the information from the respective websites and agencies, right? So BEA is Bureau of Economic Authority, no, Economic Analysis. Then you have ISM World, which will provide you with the ISM reports for the US for the manufacturing and services sector. BLS is the Bureau of Labor Statistics, where you can get information on the employment report and CPI and PPI data. And of course, we have the Federal Reserve website as well, where you can view the statements, the minutes, and press conference once they have been released. Okay, so since we are talking about Forex Factory, let's just quickly take a look. So this is for those who may not be familiar with Forex Factory. This is the website, and on the home page, you will see the economic calendar, and you're able to filter it um, through periods of time. So we are currently looking at this week, 8th to 12th of May. My time is in GMT time, right? So UTC plus 0 GMT time. And then you can filter. Okay, so I have to select my date range again. So once you select your time zone, you have to select your date range again. And then you can filter according to the currency pairs that you're interested in. And typically I keep all the event types ticked, and I will only choose the two most highest impact events to occur, because otherwise there's just way too much economic data releases that may not have a major impact on the currency pairs or the commodity that you're looking at. So as you can see, for Monday and Tuesday, it was a empty calendar with regards to high impact events. But if I just do the third one, you could see there were some other events that took place as well. Okay, so let's just stick to the two highest impacting economic events. So as I said, Wednesday, 10th of May, we have the CPI data, which is coming up in the US, where uh, inflation on an annualized basis has been falling pretty rapidly, as you can see here. But core inflation is not falling as quickly as markets would like, or perhaps as quickly as Chairman Jerome Powell and the other committee members would like. So if you look at the folder here, so Forex Factory is useful in the sense where it gives you the previous month's reading, the estimate or the forecast for the upcoming meeting and or the event, sorry, and then the actual result itself. And if you click on the graph icon, it shows you the historical, it charts the historical data for you as well. And then if you click on the folder, it opens up the details of that particular economic event, and you are able to, and it also directs you to the relevant website itself. So if I click on latest release, it'll take me directly to Bureau of Labor Statistics. And here we have all the items broken down, and we have the changes from the preceding month as well. But obviously it's easier to look at data in a chart. So if you scroll towards the bottom, you will see the PDF version of the news release, so you can read the PDF reports as well. And then we can click on news release charts. So we'll click on that, and then we shall go into 12-month percentage change, consumer price index, selected categories, plus 20 years, past 20 years, sorry. So over here, you're able to view the historical CPI readings for the various categories, right? So this is on a 12-month percentage change, or what we would call an annualized change or year-over-year change. So as you can see, since March of 2023, inflation has been ranging between, let's just say 0 and 5%, except for in 2009, because of the great financial crisis, inflation dropped on an annualized basis to a reading of negative 2.1%, but otherwise it's been ranging between 2 and about 4%. And then we had this big increase in sharp rise in inflation, and this is the scenario where central banks were raising interest rates aggressively. Okay, so maybe we'll come back to this more later when we touch on the economic uh, key economic data that's coming up tomorrow. So we'll go back to the slides. Okay, so we're back on the slides. So yeah, just a quick recap. Forex Factory is where you can get your data sets, or gives you direct you to the relevant government agencies to find out more about that particular economic data point, be it in terms of charts and reports. Okay, and okay, just to end up on the recap, we talked about monetary policy divergence, which we'll be touching on again with respect to the ECB and the Bank of Japan, BOJ as well. We talked about central bank interventions, which will be covered again because of we're going to be looking at euro yen. Then, of course, we talked about the US dollar index, which is basically which measures the relative strength of the US dollar versus its peers. And this index is or this basket of currency. The index is made up of a basket of currencies, with the euro being the having a higher weightage. It constitutes 57% of the entire basket, and Japanese yen makes up 13%. So basically, you have about 70% of the basket controlled by the demand and supply for the euro and Japanese yen. So if the Japanese yen and euro are both being bought significantly, then we can expect the dollar index to fall. So just bear in mind, the dollar index does not lead the other indicators or the other currencies. It's actually the underlying currencies that drive the dollar index. Right. So conversely, if the euro and Japanese yen are being sold off aggressively, dollar index will rise. Okay. Right. So this is just a quick recap of what we covered last time round in the first session. Okay, so there were a few questions on central euro yen and I believe it was Swiss yen, yeah, Swiss franc and the Japanese yen. So we'll just look at quickly cover what the interests, what the central banks have been doing, or the respective central banks have been doing. Okay, so this this chart shows us uh, the main interest rate for the euro area. So the ECB, European Central Bank, recently raised its interest rate by 25 basis points, bringing it up to 3.75%. So as you can see, they were a bit slow to the party with regards to raising interest rates. The Federal Reserve for raising interest rates, they started off in March of 2022, and it took the ECB about 3 months delay or wait before they finally lifted interest rates off the zero mark. Okay, so they've been raising it pretty aggressively. Definitely not as quickly and aggressively as the Fed, but they have raised interest rates pretty quickly as well. Okay, which brings us to the next chart. This is a weekly chart for the euro yen. So this was one of the requests that we had from last week. So basically, this chart also will explain monetary policy divergence. So when you have two central banks acting in in contrast to each other, where the ECB in this case is raising rates and the Bank of Japan is keeping it at negative 0.1, you would expect this currency pair to move in favor of the euro, and which is what happened for most parts of 2022. Naturally, prices don't move up and down in a straight line. There's bound to be retracements and pullbacks along the way. So this is what we saw. But overall, you can see the key bullish trend in the pair for euro yen. And okay, we also talked about the intervention by the Bank of Japan last time round. So basically, in October, November last year, the yen was being devalued, was pretty aggressively versus the dollar, with dollar yen hitting as high as 152 back in October of 2022. So when the yen was getting absolutely battered, so getting completely devalued, it actually reached 30-year lows. So dollar yen hitting 152 was a level last seen in the early 1990s. So because of that, the Bank of Japan had to intervene, because a very weak currency means that their imports become expensive, and especially when the world was experiencing rising inflation, the last thing you want is your imports to be significantly higher than what they were previously. So because of that, the Bank of Japan had to intervene in the open market. So what they did was they started selling their foreign reserves. Japan, together with China, is one of the world's largest foreign reserves that includes US treasuries and the US dollar. So Bank of Japan, they were selling their foreign reserves and using the proceeds to buy up the yen in the open market. So that is why, especially specifically with regards to the dollar yen, you saw the dollar yen pulling back quite sharply. So if we just quickly go to the chart for the dollar yen. So this is the chart for the dollar yen. So as you can see here, it peaked in this is a daily chart. So it peaked on Friday, 21st October, hitting as high as 152. And it was around this period where the Bank of Japan announced the intervention measures and started carrying out that policy, which is where you saw dollar yen peak and start pulling back significantly. So as I said, because Japan was selling, the Bank of Japan was selling their foreign reserves, which includes U.S. treasuries and the U.S. dollar. Because of that, they were selling that and buying back the yen. So the dollar yen was naturally impacted and started pulling back very aggressively. But whereas if you look at euro yen, this is the daily chart for the euro yen. Okay, so this was the period where we had the intervention, but price didn't pull back as significantly as it did for the dollar yen, because as I mentioned, it depends. It is uh, because the Bank of Japan were not aggressively selling the euro. For example, they were primarily selling US treasuries and the US dollar. So this is why euro yen actually held up relatively well, although it did start pulling back um, after the intervention measures were announced, but it was not as pronounced as the effects that we saw on the dollar yen. Okay, and in fact, actually, after pulling back towards early Jan or end of Jan, it actually made a nice bounce as well, and then pulled back and gone up. Whereas dollar yen, where's dollar yen? Is it okay? So similar moves generally, but you can see the difference in price action for these two currency pairs, right? So when you because the news of the BOJ intervention was released and was covered widely by many media outlets, right? You don't need to have a special subscription to Bloomberg or CNBC to receive exclusive news. It was like widely covered by all media outlets and your local media outlets as well, as particularly uh, for in the business section. So you would have seen that news announcement, and using that news announcement and paying attention to how they actually executed it. So they started selling their foreign reserves, and then they started buying the yen. Okay. Okay, there's a couple of questions coming in. Okay, I'll try and cover pound yen as well. And yes, gold will definitely be covering gold as well. That would be the last part for today's webinar. So okay, we'll cover that towards the end. Well, not at the end, but it'll be one of the last parts, but we'll go through that in detail as well. Okay, so going back to euro yen. So we still are in a period where we have monetary policy divergence between the ECB and Bank of Japan. So we can still expect this currency or this currency pair to be relatively elevated or to remain elevated as we progress. But do note that yen has shown strength in recent times because when you have periods of higher volatility, uh, currencies such as the Swiss franc and the Japanese yen are considered safe haven currencies. So we can see um, relatively big or large flows going into Japanese yen and Swiss franc when we have periods of high volatility that as we've seen last week as regional banking fears uh, re-emerge in the US. We saw equity markets pull back, the major indices pulling back together with VIX rising in the opposite direction. And generally, we saw larger flows coming, or we're not seeing larger flows, but we saw the Swiss franc and Japanese yen strengthen, particularly versus the US dollar. So, yeah, so this is, as you can see here, this is a daily chart for dollar yen. So 2nd May onwards, that's when the regional banking crisis re-emerged in the US, and that's when market sentiments turned. Equity markets started falling, the VIX started rising, and you can see the dollar yen pulling back pretty sharply. So this is the move that we're talking about. So this is considered a safe haven flow. So when you see equity markets pulling back, you see risk-off sentiment for equity markets. Generally, you will see the yen gaining strength versus the US dollar. So hence, dollar yen will start pulling back pretty aggressively. Similarly, if you were to look at dollar franc, so similarly here, 2nd May was when volatility started rising, equity market started falling. You could see dollar franc dropping in value as well as a lot of uh, as investors sought out safe haven currencies. But do know that this sort of moves do not last long, maybe a couple of days, as we've seen here for the Swiss franc, it just lasted 2 days. For the dollar franc, it lasted 2 days, whereas for dollar yen, it lasted over a period of 3 days. So this is also how you can take note of uh, the VIX, right? The VIX is the volatility index for the S&P 500. So if you see negative news surrounding US equity markets, you see the major indices such as the S&P 500, Nasdaq Composite, and Dow Jones pulling back pretty significantly, and you see the VIX or the volatility index rising sharply. Then it should be signaling to you that uh, potentially dollar yen and dollar franc would be pulling back pretty significantly as well. So do take note that moves like this can happen. Safe haven currency flows can happen quite regularly depending on how volatile equity markets are. But the move could last between 2 to 3 days, maybe even longer. It depends. So do take note of such high volatility periods as well, because they present uh, opportunities for currencies such as the dollar yen and dollar franc in terms of short uh, short strategies. Okay. Um, right. Okay. Then let's go back to the slides. Okay, so this is the Swiss National Bank. This is the interest rates of the Swiss National Bank. So they've been raising it since middle of 2022. Again, they were a bit late to the party in terms of raising interest rates, but they did drag themselves out of the negative interest rate uh, level, and now the SNB has raised interest rates up to 1.5%. Okay, so this was another currency pair that was requested. So okay, before doing this, sorry, I think let's just look at some quick levels for euro yen. Sorry. Okay, so for euro yen, generally, for when doing technical analysis, I usually do it on a daily chart, so I'm able to identify longer term trends, whether they're bullish trends or bearish trends. So this is why we'll now looking at the euro yen on a daily time frame. And generally, I like to use Fibonacci retracement levels and also looking at significant resistance and support levels where price action has respected that particular level. So if we just zoom out a little bit, if you just zoom out a little bit here, so we can see in October of 2022, the euro yen made a high of 148. It peaked and then it started pulling back or ranging for a while before pulling back. And then this level was finally broken in April of this year. So this also should indicate that this is a potentially key level. So we can also start by identifying. So at this point in time, this would have been a resistance level. And also you can see here what was previously a resistance level, right? Roughly around here, about 144, also served as support levels, although here it didn't respect this level, and also it acted as another resistance level here as well. So by looking on a longer time frame, or like on a longer time frame chart, and looking back as far as 6 to 8 months or 10 months, you're able to identify uh, support or not support. So you're able to identify levels where price action has respected it, right? Be it in terms of that particular price level acting as a resistance or support. And so for this, for example, here, this was, you could say, okay, previously this was another resistance level, roughly. Okay, initially it would have been here, right? And then finally it broke out, but the move was not sustained and it came back down and it retested this level here again. So you can see that 143.84 has served as a pretty significant resistance level before it finally broke out, and you had very uh, volatile moves here, and it then acted as a support level for this pair. Right, so this is how we can use support and resistance. Or I try to look at charts on a longer time frame to identify potential support and resistance levels with regards to price action. So, and I also mentioned Fibonacci retracement. So we'll pull a Fibonacci retracement here. So remember, Fibonacci always runs from left to right. So if it's a bullish trend, as we see here, it'll be from bottom left to top right. And if it's a bearish trend, we'll go from top left to bottom right. Okay, so this is how you would identify the starting and end points to run the to set up the Fibonacci retracements. Okay, so this is the Fibonacci retracement here for the current leg that we see. So basically, this dotted line that you see here, this is the trend line. And for the Fibonacci retracement levels to hold significant values, I suppose, values or significant, or to pose as significant support and resistance areas, the price action of the candle should follow the trend line pretty closely. So as you can see here, in this leg of the move, price action has respected the trend line pretty closely and is moved up in a pretty linear fashion. Okay, so what we'll do here, we will highlight all the Fibonacci levels. So these are the main levels: 0, 23.6%, 38.2%, 50%, 61.8%, 78.6%, and of course 100. These are all other Fibonacci expansion levels, but we are just going to be concentrating at the retracement levels. Okay, so if we can just maybe do a replay. So let's say, okay, this is the replay now. So let's say we saw price peak here, and on the 2nd of May, the candle closed lower. Okay, so now we have uh, a peak, a high point, and we have a low point here. So we can run the Fibonacci retracement. All right, and then you can see the various support levels. So what we want to do is also not just look at the Fibonacci retracement levels in isolation. We also want to look at it if whether they line up with any significant levels with regards to price action in the candle. So let's just remove some of these other lines for now. So the first retracement level comes in at 23.6%. So this seems like a pretty significant level, because not only is this level of 148, what is it, 14870, lining up, or 14865, sorry, lining up with the 23.6% Fibonacci level, but it also lines up pretty well with price action in the past. So we can just line it up here. Okay, so you can see in the past that this level has acted as a resistance here back on 21st October. It also served as a resistance here on 24th and 25th April. And then finally it broke out of it. So this would be uh, a level for you to take note of, because if you are long in Euro Yen, so you'll be looking to, at least in the past, be looking at this level. Probably you'll be looking at 14750 first, right? You'll be looking at this would be your first level of resistance. So you'd probably be looking to reduce your long positions here, or even perhaps take out that long position in full. So okay, so now we have this movement in price, and then we see the first level is here at 23.6%. 38.2 also seems to be a pretty good level, because you can see price react off this level here in around 25th April. And not only that, price also in the past, around 15 December, has reacted off this level and pulled back. So what was previously a resistance level now has served as a support level here. So this should be, because now with regards to this move, this should be a support level, potential support level, the first potential support level, and this 38.2 retracement would serve as the second retracement level. Okay, so let's just play out the moves and see what happened. Okay, so as you can see, price okay, as equity markets pulled back last week, Euro Yen broke through the first support at 148.65, but it did not reach the second retracement level. So this is how you can use Fibonacci to identify potential support levels in this case. And so say you had noticed that volatility was rising, banking fears were re-emerging in the US. You could see that, okay, there's potentially we should see flows coming into the Japanese yen, so you would expect the Euro yen to pull back. So by being aware of what is going on at a sort of a fundamental level with regards to the equity markets, you could have after the first day when markets started pulling back, you could have seen that, okay, perhaps on the 3rd of May, you would have identified a suitable level to go short, and you would have placed your stop loss probably just above the recent swing high, and then you would have identified the two support levels, right? So if price didn't break through the first support level, you'd be looking to probably um, at least move your stop loss closer to your entry level, or probably just uh, around break even, so that at least you are so you've actually protected your position and your capital in the event that price, you can, yeah, so you can put a run a trailing stop loss, be it an automated trailing stop loss or a manual stop loss where you manually do it yourself in your app or your platform, and then you can run the stop loss closer to your entry level point as price is moving down. And if price broke through the first resistance level or support level, you'd be looking at the second support level as the next point where price may uh, break through or may bounce off this level. So by being able to identify support levels on a daily chart, you're then able to scale in onto the smaller, shorter time frames like H4, H1, depending on your trading strategy, and then you can identify your potential exit points as well. So basically, for this move, oh, whoops, sorry, for this move was volatility coming into U.S. equity markets, and because of that, equity, the major indices pull back, volatility index rises, the VIX rises. You would generally see, or you would expect to see, the Japanese yen and Swiss franc gaining versus other currency pairs. So you would expect euro yen and dollar yen to pull back, and by um, identifying support levels using Fibonacci, and as well as looking at previous price action, you are able to identify potential take profit levels. And then if you can zoom in on the H4, for example, right, you can see how uh, you're able to structure your trades based in terms of the entry, the exit, the stop loss slightly above this recent swing high, and then as price breaks through or potentially moves towards your first support level, you can trail your stop loss as well, be it manually or uh, through an automated order. Okay, there's a question on pound yen as well. Yeah, okay, so we'll quickly get onto that as well. Okay, then, and after that we'll get on to next part. Okay, so just quickly, pound yen. Okay, so similarly, pound yen, you have a, what's this? This all old drawing. Okay, so you have uh, a scenario where the Bank of England is still raising rates. Yes, okay, and another thing to note, since we're talking about the Bank of England, okay, do note that we have a monetary policy statement coming up, or interest rate decision coming up by the Bank of England, which will be on Thursday, 11th May, 11 a.m. GMT. So this is where they're expected to raise interest rates by 25 basis points to bring it up to 4.5%. So similarly, in this scenario, you have a case where the Bank of England has been raising interest rates while the Bank of Japan has been keeping interest rates at negative 0.1%. Right. So knowing this backdrop, and also of course that's not the only fundamental piece of data that you should take note of, but it's one of the key things to note of. So because of that, you're able to sense, get an idea of how hawkish the Bank of England can be, which would potentially translate into the price action for the pound yen as well. So let's just do a quick Fibonacci for this here. So as you can see, this is a good move. As you can see, the price action is hugging the trend line pretty well and moving up in a linear fashion. So by running the Fibonacci and looking at previous levels, you're able, historical levels, you're able to identify major support levels for this particular upward move. So let's just keep, for this case, okay, just keep 33.50. Okay, so what was previously a resistance level here will now act as a potential support level as well. Okay, so even then this was a previous swing high, right? Previous swing high, which has acted very well as a resistance level as well. So seeing that price rejected this level in the past in October 2022, as price broke through what was previously a resistance level, you would potentially identify that, okay, this level of 172 would potentially be the next major barrier of resistance for pound yen. And then once you see price pulling back on a daily chart, or maybe even a 4-hour candle, you can see price pulling back on a 4-hour candle. You can run the Fibonacci from this bottom left corner to the top right and identify potential support levels. So you can see that the 23.6% lines up almost exactly with what was the previous resistance barrier. And although it didn't act uh, exactly as a clean support, but yes, uh, price did not follow through. Even though it broke through the support, there was no continuation to the downside, and it sort of respected this level and bounced back up again. So for example, over here, if you're potentially looking to take a short again, you would identify 169 as a potential exit for your short positions, and your uh, stop loss, depending on your risk reward ratio. Maybe putting it at the swing high here might be a bit too high, or maybe it's just nice 1-to-1 risk reward ratio. Wouldn't know how. I mean, that's up to you on how you want to structure your trade. But perhaps for me, probably I might put it at the recent swing high here, just above at 171, 172, for example, just slightly above 171 as my stop loss. And potentially, if you thought that if you thought pound yen was falling, you would identify 169 as the potential take profit area. So of course, don't just uh, rely on Fibonacci retracement and support and resistance levels such as this. Use indicators that you're familiar with and have uh, proven to be pretty accurate for you as well. So I like to use these levels, but if you can incorporate these indicators into your preferred trading strategy and style, then by all means do so. And it's important to um, sort of do simple back tests to see how such indicators have have performed in the past. Okay, so that's pound yen. Okay. Uh, okay, we'll just go back to our slides now. Okay, so as you can see, the Bank of Japan has kept interest rates at negative 0.1 since 2016. So they've been ultra dovish throughout this last 7 years, despite inflation rising rapidly globally. They've still stubbornly kept their interest rates at negative 0.1%. Okay, now let's just quickly look at employment report and inflation. So some of the key economic data currently that are relevant to central bank actions are like employment reports and of course inflation. So as you saw last Friday, non-farm payrolls were released and the unemployment rate was also released. So unemployment rate is now at 3.4%, which is like a 40-year low, right? They're at 40-year low levels. And non-farm payrolls have exceeded exceeded pre-COVID highs at some point last year. And we have heard a lot about the tech layoffs that have been happening, right, in the US with Meta, Amazon, and all the other major tech players cutting aggressively, right? But we don't see these figures in the non-farm payrolls and unemployment rate. All this is because although um, the layoffs as a percentage of the tech sector or as a percentage of that particular company could be relatively high, but it is important to note that the tech industry uh, only constitutes about 10 million people, right? So the almost the entire US tech industry employs about no more than 10 million, probably about 9 million people, which is actually less than 10% of the total non-farm figure. And when you have layoffs coming in, right, they may be significant as a percentage level at the company. From a company point of view, it may not represent any significant um, figure on absolute terms when you compare it to the total non-farm employment figures, right? So that is why we are not seeing uh, the unemployment rate rise sharply. We are not seeing non-farm payrolls stagnating or even dropping, right? So yeah, just take note. Sometimes uh, it can be a bit misleading to see media headlines regarding the tech layoffs, thinking that, oh, there are major cracks occurring in the labor market for the US, but actually, in fact, the labor market is still very tight. And what do I mean by tight? It means that non-farm and total non-farm employment is still rising steadily, and the unemployment rate is still uh, very low. It's actually been ranging between 3.4 and 3.6% over the past 10 months or so. So what this tells us is the labor market is very tight. The Fed or the Federal Reserve will see no reason to cut interest rates so soon. There's been a lot of talk recently about Federal Reserves trying to market participants anticipating the Federal Reserve to cut rates, but I don't think will be happening anytime soon because the labor market is still tight. Manufacturing and services activity in the US is still strong. So the best case scenario that we can get is uh, the Fed will keep rates steady. So they'll keep them at 5.25%, which is where they currently stand. Okay, so although inflation is coming down quite rapidly, right? Okay, so we saw this chart last year. CPI, last session, CPI has been falling very sharply, but core CPI has not fallen as quickly as it should, right? So if we just quickly go back here, so we can look, yes, all items less food and energy, and I remove the main headlines reading. So this is the core CPI reading. It has not fallen as quickly or as sharply as the Federal Reserve would have liked, and it's actually ticked up at the last reading. Now, for tomorrow's data, if we see uh, hotter inflation readings coming in at the core level and at the headline level, we may see the dollar index moving higher. We are likely to see bond yields moving higher as well. So this means that inflation is not done and dusted. The battle against inflation is not done and dusted, and the Federal Reserve still has work to do. So I think tomorrow's inflation data is going to be more important than ever, because if we see uptick in the core CPI and we don't see the headline CPI reading fall further, then it's very likely that the Fed is going to keep rates steady, and in fact they might even raise rates again in June. Okay, so just take note, we may have some real volatile action tomorrow. And also conversely, if the data comes in softer than expected, then naturally the US dollar will be sold off. We also expect bond yields to fall. So hence the dollar index will drop as well. Okay, so just to go back to this chart. Okay. Oops, hang on. Okay. Okay. Right. Okay. So this was covered in the first part as well. So just quickly go through this. So ISM prices average is the line in red, and it has typically led the moves in CPI over the last 20 years. So whenever ISM prices move up, CPI tends to follow it, and conversely, when ISM prices, the average of the ISM prices move down, CPI will follow suit after. So that is why you see ISM prices peaking first and then pulling back sharply, and then CPI follows suit. So because ISM is the Institute for Supply Management, and it measures manufacturing and services activity in the US, and not only do they publish the headline PMI reading for the manufacturing and services sector, they also print or publish results for the various indices, and one of them is the prices. So the prices measures the level of inflation in the manufacturing and services sector in the US. So if we see prices in this sectors rising, then naturally this will translate or feed into the consumer price index eventually. Right? So this is what we have seen historically, that ISM prices will lead CPI prices to the upside and to the downside. What is a bit concerning is recent ISM prices data, the average rather, has consolidated and is not heading any lower. So potentially this could mean that CPI reading is probably going to consolidate soon as well, right? So what would be really worrying is we see ISM prices, the average of the ISM prices start to rise again sharply, which would very likely mean that in CPI reading, the annualized CPI reading is likely to follow suit 2 to 3 months later. So that means that inflation has not been tackled, and it means that the Federal Reserve will definitely not see any reason to cut rates and may potentially continue raising interest rates again. So just take note of this from a fundamental point of view. Okay, now in the last section, we'll be looking at gold and real rates or real yields. Okay, so just going to keep this simple, right? Okay, so government bond yields are quoted in nominal terms. So for example, the US 10-year treasury bond, right? So the figure that you see being quoted will be the nominal figure, and real yields are the nominal figure uh, adjusted for inflation expectations. Okay, because the CPI readings come in on a monthly basis, but bond yields are quoted daily and weekly as well. And then we have inflation expectations, which are also quoted on a more regular basis, right? So usually, typically on a weekly basis. So real yields can be calculated by taking the nominal bond yield, and usually it's always the US 10-year as the benchmark minus the expected inflation rate. Okay, so we can, this is important because it gives us direction into the price of gold. What we are looking here is a weekly chart of gold price versus real yields. So this is a 20-year historical period. I'll show you guys where to get how to access this website as well. Okay, so the price in okay, the line in yellow is the price of gold. The axis is on the left, quoted in dollar terms per ounce, and on the right side you have the axis for the real yields, which is inverted. Okay, inverted because the reason this axis is inverted is to show you the relationship between gold prices and real yields, right? So they have actually an inverse relationship, but it's easier to visualize it when you plot the axis on an inverted scale. So what this means is as real yields move from a more positive number and go towards zero and become more negative, this is an environment where gold is sought after by investors and institutions, right? So this is a period where uh, your real yields are becoming less positive and more negative. So in this scenario, gold serves as a very good hedge against inflation. And conversely, when real yields bottom here, in the sense well, they're topping here, but in actual fact, they are bottoming. So when they go from a less negative uh, region to neutral and finally become more positive, it means real yields are becoming in positive territory, and it means generally means US uh, T bills, for example, T bills become serve as a more attractive hedge against inflation versus gold, right? Oh, okay, yeah, okay. There's a question. Okay, sure, sure. Okay, Mandy has a request. Yeah, sure. Okay, so you would like, yeah, guys, just keep taking screenshots whenever you can. Yeah, so it'll be easier for you guys to refer to. Okay, so yeah, okay. So Mandy, have you taken a picture of it? Right. Okay. I believe this should be sufficient time for you to grab a screenshot or use your phone. Okay, perfect. All right, great. Okay, so okay, right. So when real yields move into positive territory or they become more positive, gold doesn't serve as well as an inflation hedge as T-bills would. So this is why in 2013, gold actually started pulling back as real yields started falling. And during this period of mid 2013 to 2019, real yields didn't really have any clear direction or significant direction in either way, like you saw between 2009 and 2013. You saw a clear move of real yields becoming more negative, and hence gold prices followed suit to the upside. And conversely, and then looking at the period between mid 2013 to 2019, where real yields were fluctuating between neutral and about 1.1%, that's where gold was also ranging as well. So this would be a period where trading gold within the range would have been a more suitable strategy versus a buy and hold strategy as we saw in 2009 to 2013, right? So okay, so depends on whether you're a position trader or swing trader. By identifying the correct macro environment, you are able to trade gold uh, not accurately, but it gives you a better edge at trying to trade gold. So knowing that real yields are becoming less positive and heading into negative territory should be signaling to you that gold prices are likely to head higher, right? So then you can use that information together with your uh, preferred trading and incorporate that into your trading strategy or your trading style and use it for structuring your trades. So in this period where gold was ranging, this would also be a good environment for traders on a shorter term basis, right? Even if you're doing like a daily trades or intraday trades, you would still be at least able to identify the support and resistance levels and try and structure the trade accordingly. So similarly, in 2019, that's when the real yield peaked at about 1.2% and started to decrease, heading into negative territory. It's about the same period where gold started rising. So this is why it's important to take note of real yields, because they will give you a good insight into the direction of for the price of gold. Okay, so if you go to the chart, okay, so this is you can access this site. It's a free website. So if you just go to Google and you type long-term trends, right? It will be typically it'll be the first or not the second or third results. So you just click on long-term trends, and then you can go to gold, or you can view all the other charts that they have as well if you're interested. And then you click on gold, and then you look at gold versus real yields. So view chart. So this is what we were looking at, right? So this is the 20-year chart, which was what we were looking at in the slides. And we'll just zoom in a little bit to the 3-year historical chart. So these are all weekly charts, because like I said, although government bond yields are quoted on a daily and weekly basis. The expected inflation or inflation adjusted or inflation expectations usually come in on a, I guess, I think if I'm not mistaken, a weekly period, right? So this is why all the data oh no, sorry, these are all daily. Wait, sorry, daily. Yeah. So you get the inflation adjusted inflation expectations being quoted on a daily basis as well. Sorry. Okay. So why this is important? Because in early, why real yields are important? Because they really give us insights into the direction for the price of gold. Now let's just go back to early 2022, right before the invasion of Ukraine by Russia, right? So that was a major geopolitical event, right? Which caused a spike in the price of gold because it serves as a safe haven asset, right? So this was what we saw, right? On what is it 20? Yeah, 20 around 24th February. So that was the around the period where Russia invaded Ukraine. So we could already see gold prices rising uh, before that. Okay, another thing before I carry on, the relationship is not 100%, right? No correlation is ever 100%, right? For most parts of time, historically, over time, the correlation, or in this case, the inverse correlation should sit pretty tight. But of course, there will be instances or periods of time where that correlation breaks down. So it is also important to note when that correlation is breaking down and when it is actually intact. So we can see real yields becoming uh, more negative, right? And they peaked at about minus negative 1%. And that was about the same, that was exactly the same time where the price of gold peaked as well. So you would think that with a major geopolitical event taking place, with inflation uh, rising pretty rapidly over the next few months, you would think that gold would serve as a good hedge not only against inflation but also against a major geopolitical event that took place. But in fact, gold actually started pulling back, right? Since the invasion, and just after the invasion in early March, where it breached the $2,000 per ounce mark, it actually never came close to that level again. And in fact, it was actually the real yields that were dictating the move of the price of gold. So as central banks raised interest rates aggressively, the US 10-year bond yield was also rising aggressively. And uh, because in that area, when adjusted in that period, when adjusted for inflation expectations, real yields started uh, becoming neutral before heading into positive territory and became more positive. So when you have a environment where real yields are positive, generally gold does not act as a good hedge against inflation. This is where your T bills would be more attractive to hold or invest versus gold. So of course, institutions will be picking up T bills plus other investors as well. So this is a period where, as retail traders, you would have to take note of this environment and be looking to short gold in this instance, despite having a major geopolitical event taking place, despite having inflation rising pretty rapidly. In fact, gold actually was pulling back and dropped as low as the 1600 level. Of course, there were bounces in the price of gold along the way, but again, this is reflected in the direction of the real yield. So similarly here, you have this period over here. Again, this is a very good example where the correlation broke down. You can see here in towards the end of last year, December, where real yields started going from 1.08% to increase to 1.6%, and the price of gold actually just consolidated. It didn't pull back as much as we would have expected if we thought that the relationship was intact. So this is a good example where the correlation can break down, and we just have to be mindful of such situations. And then similarly, at the end of last year and early this year, when real yields peaked at about 1.6%, and it started to become less positive, this was also the period where gold was rising. Okay, so let's just quickly look at the chart of gold and just try and quickly identify some levels before we end today's session. Right. Okay. So again, this is a daily uh, chart for the price of gold. So you can see here we had a double bottom in end of February and early March. And if you look at this, you see it here as well. It is also it happened around the same time where real yields peaked at about 1.6, 1.7%. Right, so you see the double bottom here in the price of gold. You see real yields peaking uh, before turning and moving in the opposite direction. Okay, so gold has been pretty choppy recently, right? As we've seen, well, okay, sorry. What I'm trying to say is the moves in gold, either to the upside or downside, have not been as clear as they have been in the past. Like you can see here, we had from 14 April to 17 May, you could see a clear move down in the price of gold. Then it got choppy around here as well in around May, June before having another significant down leg. And then this up leg here, this retracement level or this pullback to the upside also was pretty clean. And then we was got a bit messy here as well. And this is what it looks like we're currently going through now, right? In terms of price action on a daily chart. Like this is a very messy, choppy move that we experienced in the price of gold in end November through, or for the whole of December rather. And then we had a clean break to the upside. And then finally, similarly, we had a clean break to the downside as well. So, okay, so just take note, gold price action has been pretty choppy recently, but let's quickly try and do some, oh, okay, yeah. Another thing to note of, let's just quickly zoom out to the monthly chart. This is quite important. Okay, so in recent times since August 2020, this level of this price level at about $22,070 per ounce, right? Whenever gold has come to this or close to this level, we have seen intense selling pressures, right? So we've seen it not once but three times so far. So it first occurred in August 2020, then it happened in March of 2022. And now recently it has happened this month as well, coming as close as to 2070 before uh, gold price retreated. So you can see this level, without putting any other indicators on it, is actually a very clear uh, resistance barrier for the price of gold. So this is something that we definitely need to take note of, because this is where price is currently uh, very close to, right? Price is very close to this level now. Okay, so this is a monthly chart. So sometimes it's also good to zoom out a little bit to identify major resistance and support levels. And you can see here, this chart and this line clearly illustrates that 2070, 2075 is an area where we expect to see major selling to take place. So now let's just go back onto the daily chart, right? So we can see here, this was in March of last year, and this is the current move peak that happened on 4th of May. So if we can run another resistance level as well. So just look at the body of the candle, the daily candle here, right? So this level of 2050 also lines up well with the wick here and with the body of the candle here. So these two levels between 2050 and 2075, whenever gold approaches this region, it is very important to take note that these are potentially, this is a region where we expect major selling to take place, right? So not only has this level been rejected once, It got rejected twice. Second time earlier this year in April, and it got rejected recently again. So this is a very uh, uh, very significant resistance level for the price of gold, ranging between 2050 and 2075. Of course, resistance levels are there to be broken, but given the current price action that we've seen, it would really take something significant, at least on a fundamental basis or a major catalyst for gold to break through this region of 20 price region of 2050 to 2075. Okay, so we've highlighted a major resistance level for the price of gold, and in terms of support, let's just do a quick Fibonacci here on this latest leg of the move. Okay, this is should still be relatively okay. Okay, so as I mentioned earlier, the price action of the candle should follow the trend line pretty closely. So this seems to be pretty all right for this leg of the move. And we can see the first support at around the 23% level. So not only does uh, not only using Fibonacci retracement levels, but also looking at price action of previous historical levels. So if you can see here, if I use this candle wick, we can see that around this region as well, price has sort of respected this level, right? So you can see the wick here touching here, not breaking through this level of 2006, finally breaking through, and it has been consolidating around here, has been acting as a support and resistance for the last month or so, right? And so right now I would say the first support for the price of gold would be about the 2000 region, and the first resistance is about 2050. So gold seems to be ranging within this two levels since the start of May, since last week. So do take note of these levels and take note of how economic data will impact the strength of the dollar, will impact bond yields, which will in turn impact real yields, right? So this is how you can use fundamental data, economic data as part of your process for fundamental analysis, and then uh, tie it up together with technical analysis. Do it on a daily time frame at least, because then you're able to identify the major trends in price, and then zoom in into your 4-hour charts or 1-hour charts to identify the the right trade structure uh, for your strategy, be it to the long or short side. All right. Okay. So I've come to the end of today's webinar. Uh, if okay, I'm going to launch the poll. Right, as a poll here, please do rate the poll, and also not only that, I will once the webinar ends, there'll be a quick survey as well. So please do let us know how this webinar was, the content of the content of the webinar, what topics and what future topics you would like to see as well. So okay, I'm going to launch uh, the poll. Poll was okay, right? Please do give your responses. Your valuable feedback is really appreciated, because it'll enable us to provide much better content moving forward, or not much better, but to always improve, keep improving our content for you. And also, if you'd like to see any other topics that would be interesting to you. And while we are waiting, yeah, is there any quick questions that I could go through with you while waiting for the poll to take place? Otherwise, I'll just bring your attention back to just Forex Factory, right? So main economic data events coming up today, or this week rather. We have inflation data from the US coming up tomorrow at 12:30 p.m. GMT, 10th of May. And we also have the big interest rate decision by the Bank of England coming up at 11 a.m. GMT on 11th May, Thursday, right? Okay, I hope this has been a really good session for all of you. And yeah, I think we've seen everyone vote in the poll. All right, great. Okay, thank you, everyone. Thank you for your time, and I hope this has been a fruitful session for you guys. All right. Take care and have a good trading week. Thank you, guys.